It's that heart-stopping moment when the price finally does what you've been waiting for, breaking through a ceiling it has tapped against for days, and you jump in, only to watch it reverse with violent speed, plunging right through your entry and stopping you out for a loss almost instantly. This experience, a brutal rite of passage for many, feels personal. It feels like the market has a vendetta, waiting for the precise moment you commit your capital to punish you. The novice trader often concludes that they are simply unlucky, or that some invisible force is targeting their specific trade. But the market is not personal, it is mechanical. It is not driven by emotion, but by a single, relentless, and all-consuming need: the search for liquidity. To understand this is to move from being the pawn in the game to understanding the chessboard itself. What you just experienced was not an attack. It was a business transaction. You were simply on the wrong side of it. Liquidity is the lifeblood of the market. In the simplest terms, it is the ability to buy or sell a significant amount of an asset without causing a massive price change. Imagine a small village market with only one apple seller. If you want to buy 100 apples, your large order will exhaust his supply, and the price of the remaining apples in the region will skyrocket. The market is illiquid. Now imagine a giant city wholesale market with hundreds of apple vendors. You can buy 10,000 apples and barely cause a ripple in the price. That market is highly liquid. Large operators, the institutions, and professional syndicates deal in wholesale quantities. They cannot simply press a buy or sell button for millions of shares without alerting the entire world and moving the price against themselves. To execute their orders, they need to find a deep pool of willing counterparties. They need to go where the orders are. And where are the orders? They are clustered in the most obvious places on the chart. Think about human psychology. Where does a trader who bought a stock place their protective sell-stop order? They place it just below a clear and obvious floor of support. Where does a trader who shorted a stock place their protective buy-stop order to limit losses? They place it just above a clear and obvious ceiling of resistance. And where do eager, less informed traders place their entry orders to buy the breakout? Again, just above that same ceiling of resistance. These obvious levels, the ones everyone can see on their screens, become giant, invisible pools of orders. They are pools of liquidity. The market, like a force of nature, is drawn to these pools. Price does not move because of good news or bad news. News is merely the catalyst. Price moves to facilitate trade. It moves to where the most business can be done. Let's visualize this process, this hunt for liquidity. Picture a stock that has been trading sideways for several weeks, bouncing between $90 on the low end and $100 on the high end. That $100 level is now a famous landmark. Every financial news channel has drawn a line there. Every amateur analyst has pointed it out. It has been tested 3, 4, even 5 times. Each time, the price has touched it and fallen back. With each touch, more and more orders accumulate just above it. Short sellers place their protective buy stops there. Breakout traders, growing more confident with each test, place their buy entry orders just above 100. A vast reservoir of buy orders is now sitting just out of reach, at $100.01, $100.05, and so on. The large operator who has been quietly accumulating shares down in the low 90s and wants to sell them for a profit sees this reservoir. They cannot simply sell their massive position at the current price of $99 without causing the price to collapse. So they do something that seems counterintuitive. They begin to buy aggressively, pushing the price up towards the resistance they ultimately want to sell at. This buying pushes the price through the $100 barrier. The breakout occurs. Instantly, a chain reaction is triggered. The breakout traders' orders are filled, adding more buying pressure. The short sellers' protective buy stops are hit, forcing them to buy to cover their positions, adding yet more buying fuel to the fire. A surge of euphoria rips through the crowd. The price might shoot to $101 or $102 on a massive spike of volume. This is the moment the large operator has been waiting for. Into this hurricane of public buying, they can now unload their massive inventory of shares, selling quietly and efficiently without causing the price to crash. They are feeding shares to a hungry, ecstatic crowd. Once their selling is complete, the artificial buying pressure they created disappears. The demand from the triggered breakout buyers and panicked short sellers is exhausted. And with no large buyer left, the price is left with only one direction to go. It collapses. It falls back below $100 as quickly as it rose, trapping every single person who bought the breakout. The volume on this reversal bar is often just as high, if not higher, than the breakout bar, because it contains all the institutional selling. This entire event, which feels like a cruel trick to the novice, is a textbook liquidity grab. It is the logical, calculated action of a professional operator who needs to transact business on a large scale. They did not hunt your specific stop loss. They hunted the entire pool where your stop loss happened to be located. The same logic applies at the bottom of a range. Imagine that $90 support level. Below it lie the sell stop orders of everyone who bought inside the range. There also lie the entry orders for traders looking to short the breakdown. A large operator who wants to buy a massive position will do the opposite. They will push the price down, breaking the $90 support level. This triggers a cascade of selling from stop losses and new short sellers. Panic ensues. Into this storm of public selling, the large operator can now absorb all those shares, buying up the inventory from the weak hands who are forced to sell in a panic. Once they have filled their orders, the artificial selling pressure vanishes and the price snaps back up above $90, leaving all the sellers trapped. This is often called a spring or a shakeout. It is the mirror image of the trap at the top. Both are engineered to trigger liquidity events. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding the principles laid out in that work shifts your perspective from being a victim of market moves to being an interpreter of them. You begin to see the chart not as a random series of squiggles, but as a footprint of institutional activity. So how do we use this knowledge to our advantage? How do we avoid being the liquidity that the professionals consume? This requires a shift in thinking and a clear mechanical plan. It involves patience and the discipline to act not on the excitement of the move, but on the confirmation of its failure. First, let's establish the setup. The ideal setup for anticipating a liquidity hunt is a very clear, well-defined horizontal boundary, either support or resistance. The more times this boundary has been tested, the better. The more obvious it looks, the more chatter there is about it in the financial media, the more likely it is to be a source of liquidity. A level that everyone is watching is a level that is ripe for manipulation. You are looking for a consensus of opinion, because the market often moves to cause the most pain to the consensus. So, your first step is not to trade at all, but to identify these obvious levels on your charts and simply watch them. Mark them, make a note of them, and wait. Your job is to be a hunter, and a hunter knows how to be patient. Next, the trigger for action. This is the most crucial part and where most retail participants make their mistake. The trigger is not the break of the level. The break of the level is the bait. The trigger is the rejection. Let's use the $100 resistance example again. You see the price push through 100. You do nothing. You watch. You're looking for the market to show its hand. If it is a genuine breakout, the price should hold above $100. It might come back to test it, but it should find support there. If, however, it is a liquidity grab, you will see the price fail to hold those gains. You will see it slice back down below the $100 level. This is your signal. The confirmation is seeing a candle close back inside the previous range. The breakout has failed. The trigger to enter a short position is this failure. You're not guessing. You're reacting to the confirmed evidence that the move was false. You're aligning yourself with the large operators who just sold to the crowd. Now we must address capital protection. Every single trade must have a predefined exit point if you are wrong. Hope is not a strategy. In the case of shorting a failed breakout, the stop loss is placed logically. It goes just above the highest point that the price reached during that failed move. So if the price broke 100, spiked to 102, and then fell back below 100, your stop loss would be placed at, for example, $102.10. The logic is impenetrable. The entire premise of your trade is that the move above 100 was false, and the high at 102 will not be taken out. If the price does rally back up and breaks through that high, your thesis is invalidated. The breakout may be real after all, and you must exit the trade with a small, manageable loss. There is no ambiguity, no emotion. The position is closed because the reason for entering it is no longer valid. This mechanical approach protects your capital from significant erosion and keeps you in the game. Of course, the market is a place of probabilities, not certainties. We must consider the alternative scenarios. What if you anticipate a liquidity hunt? The price breaks the level, but it doesn't fail. What if it is a genuine breakout? The evidence will be in the price action that follows. A genuine breakout, sponsored by institutions, will show follow-through. After breaking $100, it will not immediately collapse. It might pause, consolidate, or pull back gently on low volume to test the $100 level from above. This gentle, low-volume pullback is a sign of strength. It shows a lack of selling pressure. Sellers are not aggressive, and buyers are absorbing what little selling there is. The character of the price action is calm and constructive, not violent and frantic like the rejection of a liquidity grab. In this scenario, your initial thesis of a liquidity hunt was wrong, and because you waited for the trigger of a failure, you were never in the trade. You preserved your capital by exercising patience. You simply move on to the next opportunity without a loss. Another variation is the speed and magnitude of the liquidity grab. Sometimes it is a dramatic, high-volume spike that is quickly reversed. Other times it can be more subtle. The price may just creep a few cents above the key level, barely triggering the orders, and then quietly drift back into the range. The principle remains the same. The break of the level is not the signal. The inability of the price to accept and hold above that level is the signal. Whether the rejection is a violent slam or a quiet retreat, the message is the same. There is not enough genuine demand to sustain prices at these higher levels, and the supply that was just met is now overwhelming the market. You must learn to read the character of the price action. The market is always telling you a story about the balance between supply and demand. Your job is to listen to that story, not to impose your own narrative upon it. Ultimately, understanding liquidity transforms you from a participant who provides fuel for the market's moves into an observer who can capitalize on them. You start looking at charts differently. You no longer see just lines and patterns. You see a landscape of incentives and traps. You ask different questions. Instead of, do I think this stock will go up, you begin to ask, where are the stops? Where is the obvious level that everyone is watching? Where is the pain likely to be inflicted? This shift in perspective is the foundation of professional trading. It is the recognition that the market is a complex ecosystem designed to facilitate trade between large and small players, and that the movements are not random but are often purposeful actions designed to access the deepest pools of orders. By learning to identify where these pools are and by waiting for the evidence of a hunt, you can begin to move in harmony with the dominant market forces rather than being consumed by them. The journey requires patience. It demands that you sit on your hands and watch a move that you are tempted to chase, waiting for the one true signal, the confirmation of failure. It is a discipline that goes against every human instinct for action and excitement. But the market does not reward excitement. It rewards correct analysis and methodical execution. The objective is not to trade frequently, but to trade correctly at high probability moments. The failed breakout or breakdown, the confirmed liquidity hunt, is one of the most powerful and reliable setups in the entire technical analysis playbook, precisely because it is founded on the unchangeable mechanics of the market and the predictable psychology of its participants. If you wish to understand more, stay with us. The market has more lessons to teach.